I'm your host, BrightLearn, and today we're embarking on a journey through time to uncover the origins of one of the most influential institutions in the world, the Federal Reserve. We'll be exploring a captivating book by Murray Rothbard, The Origins of the Federal Reserve, which is part of his larger work, A History of Money and Banking in the United States, the Colonial Era to World War II. So, grab your favorite beverage, settle in, and let's get started. The Federal Reserve Act of 1913 didn't just pop up out of nowhere. It was a product of the Progressive Movement, a wave of legislation that swept across America from around 1900. This movement was all about transforming the U.S. from a laissez-faire economy to one dominated by centralized government control. But here's the twist. It wasn't just a grassroots uprising of workers and farmers, as historians once believed. Instead, it was driven by big businesses and powerful financial interests, particularly the House of Morgan, who were desperate to create cartels and maintain their economic dominance. In the late 19th century, competition was fierce, and attempts to form cartels in industries like railroads and large-scale corporations kept failing. The market was just too dynamic, and new competitors would always emerge to undercut these cartels. So, these big businesses realized they needed the government's help to enforce their monopolies. But how could they convince the American public, who were traditionally opposed to government-imposed monopolies, to go along with this plan? The answer? Spin. The big businesses cleverly redefined monopoly as big business or competitive practices like price cutting. They lobbied for regulatory commissions like the Interstate Commerce Commission and the Federal Trade Commission, which were often staffed by people from the very industries they were supposed to regulate. These commissions were sold as a way to curb big business monopoly. But in reality, they were tools to subsidize, restrict, and cartelize industries in the name of opposing monopoly and promoting the general welfare. This was a brilliant move. By using the rhetoric of anti-monopoly, they managed to sell the public on the idea of government intervention, all while consolidating their power. And they had the support of the nation's intellectuals, who were eager for a bigger slice of the pie. These academics, social scientists, and technocrats saw an opportunity to use the state to license, restrict, and cartelize their own professions, raising their incomes in the process. Fast forward to 1896, and we see the beginnings of a reform movement aimed at curing the inelasticity of the money supply under the gold standard. The Indianapolis Monetary Convention was a key player here. It was a gathering of businessmen, economists, and academics who pushed for a revised monetary system. They wanted to maintain the gold standard, but also create a system of elastic bank credit. The convention was anything but grassroots. It was dominated by influential corporate and financial leaders, including members of the Morgan and Rockefeller circles. They were the ones who really drove the agenda, and their influence was clear in the recommendations of the Indianapolis Monetary Commission, which called for a single gold standard and banking reform to allow for greater elasticity. The push for a central bank gained momentum after the Panic of 1907, which highlighted the need for a lender of last resort. The National Monetary Commission was established, and it was packed with experts and bankers who were sympathetic to the idea of a central bank. They toured Europe, gathering information and advice, and eventually drafted the Aldrich Plan, which laid the groundwork for the Federal Reserve System. The Federal Reserve Act of 1913 was the culmination of this effort. It created a system that allowed for coordinated inflation and provided a safety net for banks in trouble. But it wasn't just about domestic policy. The U.S. was also pushing for a gold exchange standard, which tied the currencies of other countries to the dollar, allowing for coordinated international inflation. Economic imperialism played a big role in the push for the gold exchange standard. The U.S. and other Western countries were looking for ways to expand their markets and investments abroad, and the gold exchange standard was seen as a way to integrate the economies of client states with those of the imperial powers. This was a form of monetary imperialism, where the U.S. imposed its currency system on other countries, often through coercion or manipulation. Charles A. Conant was a key figure in this movement. He was a leading theorist of economic imperialism and a proponent of the gold exchange standard. He worked tirelessly to promote this system both domestically and abroad, and his efforts paid off. The U.S. successfully imposed the gold exchange standard on countries like the Philippines, Panama, and Mexico, often with the help of local elites who saw the benefits of aligning with the U.S. economy. And there you have it, folks. The origins of the Federal Reserve are deeply intertwined with the rise of big government, the push for centralization, and the expansion of economic imperialism. It's a complex story of power, influence, and the struggle for control over the nation's money supply. I hope you enjoyed this episode of BrightLearn, and I encourage you to check out Murray Rothbard's book for a more detailed account of this fascinating period in history. Thanks for tuning in, and I'll see you next time.
This has been a BrightLearn video from BrightLearn.ai on the book The Origins of the Federal Reserve by Murray Rothbard. Visit BrightLearn.ai for more fascinating videos like this one, and visit naturalnews.com for full editorial coverage and breaking news on critical stories that keep you informed and aware of what's really going on.